to this live stream of the Fed rate cut. We haven't had a rate cut in a while. It's, according to some people, slightly overdue. Thank you for everyone who has joined so far. Hopefully we'll get a few more joiners. If anyone has anything that they want to say, this is an unusual live session, so please say it and maybe I'll pick up some of the comments. I'm sorry if I miss your comment. I've got your comment screen. I should probably move it to a different screen, but I'll move it to over here so I can see it a little bit better. Yeah, so what's happening today? In about 10 minutes time, we're going to get the results. Hello, everybody. We're going to get the results of the two-day meeting that is just concluded. And we have a split at the moment. And I'm going to show you where it is right now. Just let me refresh the screen. Let's have a look. What's going on over here? And we have, if it loads for me, it was pretty much 50-50 just a few minutes ago. It was 55% saying there's going to be a 50 basis point cut versus 45% saying it's going to be a just 25 basis point cut. The market seems to be very split. It's been yo-yoing massively in recent days. Just a few days ago, I think it was an 85% likelihood of a just 25 basis point cut. Then it swung right the other way. And yesterday, the 50 basis point cut was, I think, sitting at 67 to 70%. Now it's kind of leveled out again. So we haven't had a rate cut since 2020, and the rates have only really been going up since inflation ticked up. What's going to happen today? We're going to get the data. We're going to go through the data. There should be two different things. There's going to be the statement. That's the boring bit. The language in the statement hardly changes at all, but we'll read what it says. It'll appear over here. But then there'll also be projection materials. And this is the bit where it's usually a bit more fun because you get to see what these monkeys in the FOMC committee think is actually going to happen with interest rates and with inflation, etc. And it's amusing because if you just look back to March, to these projection materials from back in March, if you look at the projections, the majority of the FOMC thought that the rates should be at 4.5 to 4.75 by the end of the year. And there's 3 more meetings towards the end of the year. 2 of them at the March meeting thought that there should be no rate cuts whatsoever. And it's amusing when you just see like that was not very long ago when the data pretty much was already there. If you look at the more recent one, this is insane. This is June 12th, right? June 12th. At the June 12th meeting, apparently it got like less likely that rate cuts should be happening. 4 members of the committee thought there should be no rate cuts at all. Now, suddenly, they're all overwhelmingly for rate cuts with pretty much no real incremental data coming through, which is peculiar. And if you look at the data, it's not even that, it's the grouping. Look at this. Every single one of these committee members is saying that the rates should not be dropping below the 4.75 to 5 range by the end of the year. According to the Fed Watch, there's a 57% chance, according to the odds from futures markets, that they're going to drop to that today, not by the end of the year, but today. It is peculiar how apparently these learned gentlemen that make up the FOMC committee, I mean, I prefer Tweedledum, I think it's a more accurate term, can make this kind of projection. This is their actual projection as of a few days, a few months ago, June, not actually that long ago. We will get this data today so that we can all collectively laugh at it and point fingers. So there you go. Then half an hour after that, so that's happening in 5 minutes. We're going to read all this stuff. We're probably not going to read the implementation note because that's just boring as anything, and there's absolutely nothing useful in there, unless there's going to be something extraordinary, which I doubt. The minutes are not going to come out. The minutes come out sometime after, so we won't have the minutes immediately. But then there's going to be the press conference. I will turn the press conference on for you. If it's blurred, some people are saying it's probably a problem at your end. You should be able to get a 1080p feed. Select. Yeah, I don't know why it's blurred for some people. So anyway, then we're going to listen to the press conference. I'll try not to interrupt too much. I'll provide commentary if and when needed, or just generally laugh at some of the statements. Usually the first bit of the conference, the very short bit at the front, is him pretty much repeating exactly word for word what the statement that they published says. And then just after that, there's going to be Q&A. So we'll listen to all of that. I'm here. I'm ready. I have tea in the cup over here. I have Diet Coke over here. So I'm not sure what order I'm going to drink them in. That's just the drinks I had. And I thought making 2 cups of tea seems excessive. And I didn't want to only have the Diet Coke because I wanted something warm as well. Anyway, that's what I've got. I'm ready. Hope you're ready as well. So it's been a long time coming with interest rates. And a lot of people seem to disagree very strongly on the timing. There still seems to be this overwhelming prevailing belief that the Fed has timed it absolutely perfectly. If you read the CNBC, if you read all the different media, everyone's like, this is perfect. There's a soft landing. Everything's happening. If you look at some of the data, if you look at the way that the inflation data is going, it maybe doesn't quite look as rosy as some of the media will claim. Certainly in the sense that last month, when we got the data for July, we saw deflation in all non-discretionary spending for the first time in a very long time. I think there have been cases, but when we got the August data, we saw deflation in everything except shelter. And that I can't remember the last time that actually happened, because the last few times that there was a brief period of deflation in terms of CPI, in terms of consumer price index, that deflation was on an overall basis, but it wasn't across every category in regular spending. From in 2008, when the financial crisis hit, there was a brief period, but it was very chiefly driven by energy and by housing. And if you look at all the other categories, they did not fall into a deflation pattern. So it's quite unusual as a situation. And the big question mark, I think, that we're going to be really waiting for over the next few months is, has this happened way, way, way too late? Nobody knows. We'll have to wait and see. The U.S. economy has proved incredibly resilient through the inflation period, through the post-COVID period. So maybe there's going to be another rabbit coming out of a hat. But a lot of people saying it's already been announced. I doubt it. I don't think so. It's going to come out on the hour at 2 p.m. Eastern time. It's 7 p.m. where I am in the UK. The market is, I don't think it is at all obvious how the market is going to react. If anything, the most likely scenario probably is that it might be a bit of a nothing burger. So far today, the S&P 500 doesn't really seem to know what to do. It's just staying flat, not really moving anywhere. We'll have a look at this as the data rolls out afterwards, just before 4% hike just announced. Oh my goodness. People are saying all kinds of crazy stuff in the comments. By the way, if you're in my Discord and you are one of the moderators, please feel free to moderate, like in a polite, loose kind of way, just as long as we don't get anything particularly bad in there. But please kick him out if people begin spamming. 2 minutes to go. Some people just a few months ago, you would watch CNBC and you would watch people on YouTube all claiming that inflation is going to continue going up and actually is a huge problem, and the data is saying that the opposite should be happening. There should be increasing rates. I remember distinctly in March and April a number of people attacking me for saying that the rate cuts should have started already, and saying inflation is a massive problem. It's interesting how quickly people's perceptions change and how much all of this changes. I'm just going to refresh this window. I know a lot of people are just writing stuff. If you want to join my Discord, my Patreon link in the description, feel free to go and do that. You don't have to. You can just watch my videos on YouTube, but it's just $5 a month if you fancy joining. But people writing all kinds of nonsense. Here we go. There's more than one mod. I can see a few different mods in the chat. Let me make another person a mod. I can see some people who are add as moderator. There we go. Okay, I can see people from the Discord. I've made some more mods. Right, is the data in? Where is it? Give it to me. I'm guessing the news is going to go first. Oh, here we go. Statement. Here we go. Oh, it's a big cut. We've got 0.5 percentage point cut over here, down to the 4 3/4 to 5% cut. The Fed apparently have some balls, and especially the most crazy thing, 50 basis point cut. The most crazy thing with this is that this comes literally 2 and a bit months. What is it? July, August, 3 months after this exact same committee said that it probably doesn't need to be doing much cutting, or actually not as much cutting as they've already done through to the end of this year. So let's read this. We know it's a 50 basis point cut. I know that the language in here is boring, but let's just read it in case there is something interesting. Recent indicators suggest economic activities continued to expand at a solid pace. Job gains have slowed, and the unemployment rate has been moving up but remains low. Oh, the Fed has managed to finally get the data that was already obvious a few months ago, but now they have the data because the data is now in the rearview mirror. So it's about time to do something. Inflation has made further progress towards the committee's 2% objective. And further progress is inflation is currently negative except shelter, and shelter is a lagging indicator. And so shelter is only sitting at whatever it is, 5%, because it hasn't actually caught up with the reality of prices. It's a lagging indicator because it takes time for people to move. And only when you move do you feel, you experience the actual changes in rent prices and in mortgages and house prices and stuff like that, right? That's why it's lagging. It's not lagging because it takes time for them to collect the data. It's lagging because of the way that it actually translates to human behavior. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. Yeah, well done. It's already negative, but yeah. The committee has gained greater confidence that inflation is moving sustainably towards sustainably, and judges that risks to achieving its employment inflation goals are roughly in balance. The economic outlook is uncertain, and the committee is attentive to the risks to both sides of its dual mandate. In light of the progress on inflation and the balance of risks, the committee decided to lower the target range of the federal funds by 0.5 percentage point. A lot of people said that they don't have the balls to do that. I mean, like a few days ago, it was inconceivable. It was like, no, it would only be a 25 basis point cut. How dare you, Sasha, say that it should be more? Here we are. Things change very quickly to 4.34, to 4 3/4 to 5%. So 50 basis point cut. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee will continue reducing its holding of treasury securities and agency debt and agency mortgage-based securities. So what they're saying is they're going to continue reducing the balance sheet. So they're reducing the rate. They're not going to stop reducing the balance sheet. The committee is strongly committed to supporting maximum employment return inflation 2% objective. Maybe we do need to read the implementation note to see if the pace of this is going to change. Let's finish this. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. Boring. There's nothing here. All right. A bunch of names. All right. But let's have a look. Voting for monetary policy were all of these people. Voting against was one person, Michelle Bowman, who preferred to lower the target range for the federal funds rate by 0.25 percentage point at this meeting. So they were almost in unison voting for this, even though just 3 months ago, or pretty much none of them thought that there was going to be a need to lower the rates this much this year. Right. So what else we got? Decision regarding... Is there anything in here? Effective September 19th, the Federal Oil Market Committee directs the desk to undertake a market. Change the rate. I can't see anything about the pace. 35 billion per month into Treasury securities. What was it? What was it before? I can't remember. All right, let's go and have a look at the projections. Because so if you're just joining, what we're going to do is going to look at the projections. We're going to laugh very hard at the projections, especially compared to what happened last time. And then we're going to wait until past while going through the data and analyzing it. And we're going to listen to Jerome Powell go and do the speech. I'm sorry, I'm not keeping up with the commentary, but if I see something interesting in there, I will try to reply. But stocks are stonking. What's the S&P 500 doing? I don't have the live feed. Oh, S&P 500 thinks this is good. Interesting. There we go. It's not a huge move, only a 0.5 percentage point so far, but we'll see. Maybe somebody's got live data. I don't have data. All right, I'm betting tech stocks like it a lot, especially small tech stocks. The Russell 2000 stocks, they're probably liking it quite a lot. We'll see later. Right, projection materials. Oh, this is good. I'm looking forward to this so much. Let's have a look. If you can see a fluffy white thing walking around in the background, it's my dog. So if you can see a fluffy tail floating around, that's what it is. It's not my feather boa. Has the price of McDonald's cheeseburger come down? That's all I care about. All right. Apparently, food not at home is one of the categories that is not currently negative. All right. Here is the projection. So remember, a few months ago. Let's open them side by side so that we can compare, because that way it will be more funny. So here's the June one. Let's have a look. Here is the June one. And in June, all of the committee members thought that the rate would be at where it is today or higher. Today, those same people think, so the biggest number of people think that there's going to be another 50 basis point drop between now and the end of the year. So 2 more meetings, so another two lots of 25 basis point cuts, or 150 basis point cut and then no cut at the other meeting. But presumably it's the 225 basis point cut. That's what these guys think. These guys over here think there's going to be one more 25 basis point, one more 25 basis point cut and no cut at the other meeting. 2 people think there should be no more cuts at all, which is kind of bizarre, because if you're voting, so remember, all bar 1 voted for the 50 basis point drop today. Hello, Toby. Everyone bar 1 person voted for the rates to come down 50 basis points. So how is it that if they thought that it should come down 50 basis points today, at the same time, these people think that there should be no more rate cuts at the next 2 meetings? These 2 things just don't really line up. It doesn't make sense. Print. There's no printing. They're still reducing balance sheet. 1 person thinks that there should be another 75 basis points to come off. So 25 basis point cut at 1 meeting and a 50 basis point cut at another meeting. But this is bizarre. The fact that there's 2 up here and then 7 people over here, so 9 people over here think there should be no cuts or just a 25 base. So they're saying at least one of the meetings there should be no cut at all. So there you go. Interestingly enough, there's a big drop down here where they're kind of saying that the rates are going to go down to sit at around 3% in the longer term, and kind of just hover there. And you can see that it almost gets there by the end of 2025, by the end of next year. So this second lot of dots is 2025. And then it's going to sit around. Now, it's interesting because this was completely not what they thought at the meeting in June. See, in June, they thought the rates would stay high, or like above 4%, right? So they were saying, like, look, the majority is saying 4 to 4.25 or even 4.25 to 4.5. So the majority is saying is going to be at 4.25 or 4.5%. At the last meeting, this is June data, and now these same people are saying actually is going to drop by over a percentage more, over 1% more. So that's quite a fast change in perceptions. I'm really confused because when you look at the macro data, there really hasn't been that big a shift in terms of what the data was saying 3 months ago and what it's saying today. I mean, sure, we got some slightly higher unemployment data, but you could tell from the trajectory where it was going. Like yesterday, we got more data coming through on, what was it, on the sales index. And that's just, the graph just keeps slowly going down and down and down. We were discussing it in the Discord. Like, I don't really understand how this was not already obvious, but there you go. The interesting thing is they're saying, look, it's now going to bottom out at about 3%. if you look at the chart from June, this is the June data over here. They were saying the longer term, so longer run data, so basically like 3 to 4 years from now, it's actually going to begin to kind of going down here, going towards the 2.5% or so. Now, although they're saying it's going to begin reducing a lot faster in the next year, at the same time, they're saying that it's going to end up being higher. So I'm not sure. I don't know if you're sure. I don't know if anyone knows what's going on here. But that's what they're saying. Now let's go and have a look at what they're saying for the actual financial data. Remember, this is the members of the FOMC. This is those bigwigs, the bosses of all the different central banks in the US, who are part of the FOMC. This is what they thought in June. In June, they thought change in GDP would be sitting at basically 2% every single year. Very interesting, and this pretty much hasn't changed. They've added one more year, but there hasn't really been any movement. So in June, they thought it would be flat to slightly going down over the next 3 years, like getting worse. Now they're saying it's going to get slightly better. Like it's going to go up and up and up, like slightly up. Okay. Unemployment rate. What are they saying? At the moment, they're saying it's going to tick up ever so slightly. Let's have a look. Fed unemployment rate. I love these projections in how non-committal they are. In how hey, let's not predict anything. So here is the unemployment rate. And you can see, obviously, like we had the COVID spike, and then it came down, and it was sitting around like 3.5, 3.6%, and then it began climbing, 4.3. It's ticked down slightly to 4.2 in August. A whole lot more people got classified as economically inactive and a bunch of stuff like that. But they're basically saying, look, ignore the curve, ignore the fact that like it's just gonna stay exactly where it is, right? This is the projection. The projection is like unemployment rate. It's at 4.3%. Find 4.3% here. Guess here, and then just say it's not going to move, and it's going to get slightly better. Okay, all right. I mean, like, what's the point in these projections if you're just going to say for every assumption that it's just going to be whatever it is right now? Just put that down. Put me down for that. Pass me a bit of caviar. Where's my champagne glass? What I need to make just whatever it is right now. Put that down. Okay, PCE inflation. This is the Fed's preferred metric because it doesn't have much granularity. I'm sorry if you can hear my dog's like trying to kick my computer or something. PCE inflation. So they're saying, okay, so this is very interesting. So they're saying that inflation overall, by the end of the year, is going to be basically at 2%, give or take. A few of these people think that it's going to be more like 2.4, 2.5%, right? This top line over here. This is like the upper range of what they think. But then they're saying it's just going to, from 2% or just above 2%, stay at 2% completely forever. And there's like, you can see the range here. None of these people think that it's going to go below 2%. Not a single one of these members thinks that it's going to go below 2%. Not a single one of these members thinks that it might tick back up. Like literally, stick me down for 2%. We're all like, everyone agree? Yeah, okay, 2%. That's what we're going to put down. Core PC inflation. They think core is going to drop a little bit more, presumably because shelter is going to catch up, and shelter is like 60% of core. And we already know what the shelter number is going to be because we already have the 18 months of data on what actual house prices are doing, what actual rent is doing. And the answer is that it's been at 0 for the last 18 months or so. And so we know that shelter is going to be coming down, and they're basically saying, well, look, okay, core is going to come down. But what that means, and this is interesting, what that means is if shelter is going to be coming down and core is going to be coming down slightly, not hugely, but slightly with it, then that must mean that they're expecting food and energy to go up, right? Like, because these, so core is what? 70, I can't remember. It's a very big chunk, and the drops here see more than 70% of these. So it looks like they're basically saying food and energy are going to tick back up slightly. That's my take. Because if you do the math between these two, so there you go. That's the data. What else have we got? What else we got to laugh at? I haven't seen the comments. Maybe I should see. It is a 50. If you're just joining, it's a 50 basis point cut. Maybe slightly unexpectedly, as of a few days ago. My opinion, still too low, but there you go. A lot of people will disagree. A lot of people think that doing a 75 basis point cut or 1.5% basis point cut would be too much. But there we go. Distribution projections for the change in real GDP. Distribution. So there's a bit of a So they're basically saying, like, we're definitely going to be. So if you look at the June projection, they were saying it's going to be more like 2.2, 2.3%. Now they're saying it's going to be almost unanimously exactly bang on 2%. And it's interesting because so far, the latest data point that we have is August. So we still have 4 months worth of data to come in. We're at 2.5% at the moment. And it's interesting because September last year was plus 0.4% in CPI month to month. And I know this is not CPI. Sorry, this is GDP. What am I looking at? I'm looking at the wrong thing. Where's CPI? PCE inflation. Okay, PCE inflation. They were saying it's going to be 2.5, 2.6 in June. They're now saying it's going to be 2.1 to 2.4. Same thing. But it's interesting because this kind of presumes that there's going to be no movement in inflation at all over the next 4 reads. No movement because September data is likely to displace a very high bar from last year. So if September comes in roughly the same level as what it was for the last several months, like 0 to 0.2% month-to-month movement, then we are already at like 2.2 to 2.3 territory. So what they're saying is, aside from that, there will be no further downward movement at all, and shelter will not continue coming down. Shelter being 37% of the total, and we kind of know that it really probably will be coming down quite considerably. So this is bizarre to me. This is bizarre that not a single one of these people thinks that the 2024 number is going to be below 2% at the end of the year, because I think it is now becoming incredibly likely, like a reasonably high probability that it's going to be below 2% when we get the December read in January. But hey, we will have to wait and see when we get there. And they're saying, look, they're basically saying soft landing here. Look, if you look at the projections, they're basically all saying, look, it's going to hit 2%, stay just above 2%, then dip to basically be just a tidge just below 2% mark, pretty much bang on. So they're patting themselves in the back. They're saying, yep, good job. This is what's going to happen. And distribution for PCE inflation, exactly the same. What's this? Distribution participant judgment at the midpoint of the appropriate target range. Okay. So this is like that dot plot, but in a different format. Okay. So the dot plot says, so they're basically saying, okay, what is the scale? 4.38 to 4. Like, who did this? Which intern did this? Sack the intern. This is horrific. Why not just do the ranges that they always use in these charts? Oh my God. Yeah. So they're basically saying that the interest rate is going to come down another 2 25 basis point drops. These guys over here, the 4.38, these guys. And these guys are saying there's going to be only one more drop, but no drop at the other meeting. One person, or 2 people saying there's going to be no drops at all, and one person thinks there should be 75 basis points worth of drops. Interesting that the person who thought there should be 75 basis points worth of drops through to the end of the year did not vote for a 75 basis point drop at this meeting. So there you go. Thank you to the moderators, by the way. I can see the moderators are getting out the ban hammer. Thank you very much. And what they're saying is after that, 2025, and then 2026, the rate will slowly tick down. So you can see it's going to go down another 1.25% through the whole of 2025. So that's 25 basis point drops, which it seems very slow and steady, kind of more slow and steady than it was on the way up. And generally speaking, it is incredibly rare and unlikely for the interest rate to go down so slowly. And I know this is a difficult one because historically, when you look at the interest rates going down, let me just open it up. When you look at the interest rate going down, the problem with this chart, here, let me just stick it on here. The problem with this chart is it typically tends to come down when there is a massive problem and the Fed is trying to cure the problem, right? So they're saying, pat ourselves in the back, everything's going to be great. We're going to have a slow and steady reduction, possibly a little bit like this one over here. I know that there was the early 90s recession, but generally speaking, like the rate reductions over here were relatively calm and measured compared to what happened in the dot-com crash, compared to what happened in 2008, compared to the Volcker reductions after the interest rates went to the moon, compared to what happened after the oil crisis over here in the 70s. Like almost every time when the rate comes down, it's trying to solve a massive problem. And the question is, are we going to have a massive problem to solve, in which case other rates going to come down faster? And even if we don't, will the rates come down faster because, well, they might begin heading towards deflation or other problems? So there we go. In 9 minutes, we're going to listen to Jerome Powell. And I have him ready. I've got him here. I've got it ready over here. We're going to listen to what he has to say. There's going to be a press conference. He's going to make a quick statement. Then he's going to answer some questions. I am really hoping that the questions are, because it seems to alternate quite a lot with the questions. Sometimes the questions are just so meaningless and playing into what the Fed wants to say anyway. I'm hoping there's a bit of challenge on or why is it, like the question that I'll be asking, I think, based on this release is, why is it that none of the members think that inflation has any chance of dipping below 2% when inflation is at 2.5%, but the inflation minus shelter is already negative? So, if shelter was to continue going down like it has been, which is extremely likely, then inflation is very probable to go below 2%. And yet not a single member of the committee thinks that. And I find that bizarre, because the data the data is there. We already know the data. I mean, look at the Zumper report. Where is the Zumper report? Let me get it out for you. I mean, it's ticked back up towards 2%, but it's been sitting at like pretty much 0% for best part of the year. And during this period, the rent part of shelter inflation has been sitting at 6% or thereabouts. It has to catch up, because it always does. It will catch up with this data in due course. So even if prices begin going up from here, shelter will continue going down because it still has to catch up with the movement that has already happened. All right, let's get rid of this. 57% were correct according to futures markets. What's the stock market doing? The stock market wildly celebrating? Not really. The stock market is like, yeah, okay, yeah, whatever. I think that probably, in my view, would be roughly the expectation for both. Yeah, 25 basis points, 50 basis points, it doesn't really matter. You went 50? Okay, fine. Thank you. I'd like people to ask questions about the projections of inflation going forward. I expect that if they do, then Jerome is just going to bat it back by saying something along the lines of, well, we think it's going to be a soft landing because we're really smart. And I don't know if anybody is going to probe that by, pointing to the fact that so many categories are now actively negative. More cuts needed. Well, we've got spammers. No, cuts. Hey, Sasha, thanks for the analysis. Thank you for joining, everybody. I'll see if I can stick one or two comments. If there's something worth sticking, I will try to do it. But so yeah, if somebody has something interesting to say in the next 5 minutes before Jerome Powell speaks, please do, and I'll see if I can stick it on the screen. But yeah, a question on projections. I think another question on what are their plans for managing the balance sheet. Obviously, the balance sheet has still got a long way to go for the Fed before it gets anywhere remotely near what it was before it blew up. But reducing the balance sheet as they are today is relatively unprecedented and not something that's happened before. And as they're reducing the balance sheet, even though the rate may not be as punitive, remember in previous cases where rates were going down, they weren't doing the aggressive balance sheet reduction at the same time. And at the moment, even though the rate is going down 50 basis points, they're on top of that still continuing to do the quite aggressive reduction in the balance sheet. And it's going to be a good question as to what does that mean for the actual long-term impact and the effect of the policy, because even though the rate is not as punitive, it's not 100% of the treatment, right? It's kind of saying like, you're taking these two different boxes of pills. If we reduce the dosage on one of them, you're still taking the other one. And so because that's not the popular thing, when you read the media, nobody's going to be printing stuff about what's happening with the balance sheet. Everyone's just going to be focused on the interest rate only. And the Fed knows that. And that's why like that's the bit that everyone cares about. That's the bit that everyone talks about. Nobody cares about the other thing. So let me have a drink before Jerome Powell speaks. The S&P 500 is still going nowhere. Yeah, very, very muted. I'm guessing tech stocks are having a bit of fun, but I can't be bothered to look at that right now. For anyone who's just joined, just before we hear from Jerome Powell in 4 minutes' time, he's going to come out and do a press conference. It's going to be live right here. Just before we get that, the Fed reduced rates by 50 basis points to a target range of 4.75% to 5%. Somewhat against the run of play, sometimes the expectations. As of a few days ago, I was talking to lots of people just 4 or 5 days ago, and it was sacrilege to say that rates should go down more than 25 basis points. A lot of people kind of saying, hey, maybe they should wait a bit longer, despite what Jerome Powell said at the various different meetings and conferences recently. Yeah. I think even my dog is surprised. Look, she can you see the ears? Hello. She wants to hear what Jerome Powell has to say. So the projections are saying that the Fed very much expects a soft landing. The Fed expects the inflation to slowly tick down towards that 2% mark, and everything is going to be dandy. We will have to find out if that happens. But in 2 minutes' time, let's stick the Fed video on. Is it gonna work for me? I don't know. Still nothing. But hopefully sound will work, because I think I've made it work. I've not done a live video in a little while, so if it doesn't work, I will fix it. But bear with me. It might take me a few seconds. So what are people saying? People talk about options. Yeah, there's not very much in the way of constructive stuff. Here we go. What's this? Sasha, why not even the reporter seems to not bother with the right questions about why no one is thinking shelter is a lagging indicator and the core inflation should be way down? I have no idea. I don't really know. I don't understand why, because like the things that I talk about on my channel are not rocket science. In fact, it is extremely straightforward and relatively simple. When I was saying inflation is heading right back down for some time, despite that being extremely unpopular, I think people have forgotten how unpopular an opinion it was at the beginning of this year, that inflation is going to head right back down to 2%, and it's definitely going there because we can see it from all data, from all the advanced data reads, etc. It was extremely unpopular to make that claim, despite, in my opinion, the evidence being overwhelming. At the moment, it's kind of the same. You can see all the data pointing to the fact that inflation is heading below 2%. Maybe things will begin ticking up. Maybe the economy is waiting for the rates to come down and is suddenly going to go and explode. Music is grim. What music? Wait a second. Sorry. I can't hear the music. Why can I not hear the music? Let me... Oh, sorry. I'll turn it off. I'll remove this. I'll just stick myself on here. It's not playing the music in my headphones. Okay, let me just let me do something different. I'll just turn on the tab. That should work better. There we go. All right. I can hear the music now. I don't know what's happening. Oh, here we go. Here we go. Jerome. Where is he? Where is he? Is he finishing the caviar sandwich? Last week of the champagne. Oh, here we go.
Good afternoon. Progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a 0.5 percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%.
Soft landing.
We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years.
Which AT software did they use for that?
In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up, but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a half percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks.
Data in the rearview mirror.
SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward.
I can't believe how bad these slides
If the
are. It's
economy evolves as
pixelated.
expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond.
No
Policy
shit.
is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Yay! It's going to be fun, I'm hoping.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking our questions. In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you were thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed and made the committee go 50? And how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess, should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
Should we expect more 50s?
So, okay, a lot of questions in there. Let me jump in. Since the last meeting, we have had a lot of data come in. We've had the two employment reports, July and August. We've also had two inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. And so we took all of those And we went into blackout and we thought about what to do. And we concluded that this was the right thing for the economy, for the people that we serve. And that's how we made our decision. So that's one question. What was
That was a
the
non-answer.
second and
How
third?
do we make the, sorry, thank you, sir.
Complete
How
non-answer.
do we figure out in the months ahead, is there another 25 or 50 coming in based on what shall we make that call? Thank you.
Sure. So a couple things. A good place to start is the SEP, but let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we were contemplating. I would point you to the SEP as just an assessment of where of what the committee is thinking today, what the individual members rather of the committee are thinking today, assuming that their particular forecasts are realized.
Go ahead, Chris.
Hi, Chris Rugaber at Associated Press. Thank you. The projections show that the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year. So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid? Or does it suggest that maybe people see the short-run neutral as a little bit higher?
Yes, that's the question we wanted. Phrased very nicely.
Characterize it as this. I think people write down their estimate, individuals do. I think every single person on the committee, if you ask them what's your level of certainty around that, they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know it by its works. So that leaves us in a place where we expect in the base case to be continuing to remove restriction, and we'll be looking at the way the economy reacts to that, and that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know, if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2%. Inflation's down to a few tenths above 2. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment moving to a more sustainable level. So the balance of risks are now even. And this is the beginning of that process. I mentioned the direction of which is toward a sense of neutral. And we'll move as fast or as slow as we think is appropriate in real time. But what you have is our individual accumulation of individual estimates of what that will be in the base case.
I think the face of the person asking the question said it all. Like, what?
Howard
What?
Schneider with
confused.
Reuters. How close was this in terms of the decision? You do have the first dissent by a governor since 2005, I think. Was the weight clearly in favor of a 50, or was this a very close decision?
I think we had a good
Almost
a good
unanimous,
discussion,
right?
If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut, left it open. And I think we left it open going into blackout. And so there was a lot of discussion back and forth, good diversity of opinion, excellent discussion today. I think there was also broad support for the decision that the committee voted on. So I would add, though, look at the SEP. All 19 of the participants wrote down multiple cuts this year, all 19. That's a big change from June, right? 7 of them wrote down 3 or more, 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So there is a dissent and there's a range of views, but there's actually a lot of common ground as well.
Follow up to that, now that this is in the books, can you give us some guidance as sort of follow up to Steve on the pacing here? Would you expect this to be running every other meeting once we get into next year?
Yeah, we're gonna take it meeting by meeting. As I mentioned, there's no sense that the committee feels it's in a rush to do this. We made a good, strong start to this, and that's really, frankly, a sign of our confidence that inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, make a good, strong start, but and I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting, and make our decisions as we go.
Gina.
Hi, Chair Powell. Gina Smilik, the New York Times. Thanks for taking our questions. You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing.
Yeah,
And so I
good
wonder if
point.
you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
Exactly. Like,
So,
what is just going to stay there?
Again, the labor market
Exactly
is
the same.
actually in solid condition, and our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
Sorry, Nick.
Nick Timmeros of the Wall Street
Completely
Journal.
avoided.
Chair Powell, does today's action constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue?
Okay,
He's not going to answer that one.
multiple
100%.
questions there, but so I would
100%
say
not going to answer.
we don't think we're behind. We do not think we think this is timely, but I think you can take this as a sign of our commitment not to get behind. So it's a strong move. Sorry, your other question was?
Well, is this about what happened in the employment data between this meeting and the last meeting, or is this about the level of the funds rate, the high nominal level of the funds rate relative to what might be expected if you're trying to maintain equilibrium?
So I think it's about, we come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation and very low unemployment. We've been very patient about reducing the policy rate. We've waited. Other central banks around the world have cut, many of them several times. We've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably down to 2%. So I think that is what enables us to take this strong move today. I do think that anyone should look at this and say, "Oh, this is the new pace." You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is, look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate given developments in the economy in the base case. The economy can develop in a way that would cause us to go faster or slower, but that's what the base case says.
Yeah,
If I could
didn't
follow
answer.
up on the balance sheet. In 2019, when you did the mid-cycle adjustment, you ceased the balance sheet runoff. With a larger cut today, should there be any signal inferred about how the committee would approach end state on the balance sheet policy?
Very on point question.
In the current situation, reserves have really been stable. They haven't come down. So reserves are still abundant and expected to remain so for some time. As you know, the shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrinking, but also be cutting rates.
Colby.
Thank you. Colby Smith with the Financial Times. I'm just following up on Gina's question on rising unemployment. Is it your view that this is just a function of a normalizing labor market amid improved supply? Or is there anything to suggest that something more concerning perhaps is taking place here, given that other metrics of labor demand have softened too? And I guess in direct follow-up to Gina is, why should we not expect a further deterioration in labor market conditions if policy is still restrictive?
So I think what
Exactly.
we're seeing is clearly labor market conditions have cooled off by any measure, as I talked about.
Number
in
of job
Jacksonville.
openings has halved.
And but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it? Clearly, payroll job creation has moved down over the last few months, and this bears watching. Meant by many other measures, the labor market has returned to or below 2019 levels, which was a very good, strong labor market. But this is more sort of 2018, 17. So the labor market bears close watching, and we'll be giving it that. But ultimately, we believe, with an appropriate recalibration of our policy, that we can continue to see the economy growing, and that will support the labor market. In the meantime, if you look at the growth in economic activity data, retail sales data that we just got, second quarter GDP, all of this indicates an economy that is still growing at a solid pace. So that should also support the labor market over time. So, but again, it bears watching, and we're watching.
And just on the point about starting to see rising layoffs, if that were to happen, wouldn't the committee already be too late in terms of avoiding a recession?
So our plan, of course, has been to begin to recalibrate. And as you know, we're not seeing rising claims. We're not seeing rising layoffs. We're not seeing that. And we're not hearing that from companies that that's something that's getting ready to happen. So
We're seeing it. It's in the data.
Because, there is
Literally.
There is thinking that the time to support the labor market is when it's strong, and not when you begin to see the layoffs. There's some lore on that. So that's the situation we're in. We have, in fact, begun the cutting cycle now, and we'll be watching, and that'll be one of the factors that we consider. Of course, we're going to look at the totality of the data as we make these decisions meeting by meeting.
Michael.
Michael McKee with Bloomberg TV and Radio. To follow up on that, what would constitute for you and the committee a deterioration in the labor market? You're pricing in basically by the end of next year, 200 basis points of cuts just to maintain a higher unemployment rate. Would you be moving to a more preemptive monetary policy style rather than, as you did with inflation, waiting until the data gave you a signal?
Yeah, still staring in the
We're gonna
rear
be
view
watching
mirror.
all of the data, right? So if, as I mentioned in my remarks, if the labor market were to slow unexpectedly, then we have the ability to react to that by cutting faster. We're also going to be looking at our other mandate, though. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%, over time. So, and policy we think is still restrictive, so that should still be happening.
I'm just curious as to how sensitive you'll be to the labor market, since you forecast we are going to see higher unemployment and it is going to take a significant amount of monetary easing to just maintain it.
So, what I would say is we don't think we need to see further loosening in labor market conditions to get inflation down to 2%. But we have a dual mandate, and I think you can take this whole action as take a step back. What have we been trying to achieve? We're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment that has come sometimes with disinflation. That's what we're trying to do. And I think you can take today's action as a sign of our strong commitment to achieve that goal.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You're describing this view that you don't think you're behind when it comes to the job market. Can you walk us through the specific data points that you found to be most helpful in the discussions at this meeting? You've mentioned a couple, but would you be able to walk us through what that dashboard told you as far as what you know about the job market now?
I love this.
So we'll start with unemployment, which is the single most important one probably. You're at 4.2%. That's, you know, I know that's higher than we were used to seeing numbers in the mid and even below mid threes last year. But if you look back over the sweep of the years, that's a very healthy unemployment rate. And anything in the low fours is a good labor market. So that's one thing. Participation is at high levels. It's, you know, we're right adjusted for demographics, for aging. Participation's at pretty high levels. That's a good thing. Wages are still a bit above what would be their wage increases, rather, are still just a bit above where they would be over the very longer term to be consistent with 2% inflation, but they're very much coming down to what that sustainable level is. So we feel good about that. Vacancies over, you know, per unemployed is back to what is still a very strong level. It's not as high as it was.
It's not. It's
That number
half
reached
what it
2 to
was a
1,
year
2
ago.
vacancies for every
It's
unemployed
half.
person, as measured. It's now below around. It's around 1, but that's still a very good number, I would say. You know, quits.
It's a historically very low
have
number
come back
for
down
an
to normal
economy
levels.
that's not
I mean,
in a
that can go
downturn.
on and on. There are many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change particularly over the last few months. And, you know, so what we say is as the risks, the upside risks to inflation have really come down, the downside risks to employment have increased. And because we have been patient and held our fire on cutting while inflation has come down, I think we're now in a very good position to manage the risks to both of our goals.
And what do you expect to learn between now and November that will help inform the scale of the cut at the next meeting?
You know, more data, the usual.
She's good.
Don't look for anything else. We'll see another labor report. We'll see another jobs report. I think we get a second jobs report on the day of the meeting, I think. No, on the Friday before the meeting. And inflation data. We'll get all this data. We'll be watching. You know, it's always a question of look at the incoming data and ask what are the implications of that data for the evolving outlook and the balance of risks, and then go through our process and think what's the right thing to do. Is policy where we want it to be to foster the achievement of our goals over time? So that's what it is, and that's what we'll be doing.
Neil.
Did not answer that at all.
Hi, Chair Powell. Neil Irwin with Axios. We've only been running a little above 100,000 jobs a month on payrolls the last 3 months. Do you view that level of job creation as worrying or alarming, or would you be content if we were to kind of stick at that level? And relatedly, you know, one of the welcome trends of the last couple of years has been labor market steam coming out through job openings falling rather than job losses. Do you think that trend has further to run, or do you see risk that further labor market cooling will have to come through job losses?
It's like part two to the previous question.
On the job creation, it depends on the inflows, right? So if you're having millions of people come into the labor force, and you're creating 100,000 jobs, you're going to see unemployment go up. So it really depends on what's the trend underlying the volatility of people coming into the country. We understand there's been quite an influx across the borders, and that has actually been one of the things that's allowed the unemployment rate to rise. And the other thing is just a slower hiring rate, which is something we also watch carefully. So it does depend on what's happening on the supply side. And on the beverage curve question, yes. So we all felt on the committee, not all, but I think everyone on the committee felt that job openings were so elevated that they could fall a long way before you hit the part of the curve where job openings turned into higher unemployment, job loss. And yes, I think we are. It's hard to know that you can't know these things with great precision, but certainly it appears that we're very close to that point, if not at it, so that further declines in job openings will translate more directly into unemployment. But it's been a great ride down. I mean, we've seen a lot of tightness come out of the labor market in that form without it resulting in.
It's hard to know that if there's less jobs going, that unemployment will go up. 100%. It's very hard to tell. Impossible. Some people say it's impossible to tell.
So we've heard some speculation that you may be going with the federal funds rate to 3.5, maybe under 4%. And there's basically an entire generation that has experienced zero or near zero federal funds rate. Now some think we're heading in that direction again. What's the likelihood that cheap money is now the norm?
So this is a question, and you mean after we get through all of this? It's just a great question that we can only speculate about. Intuitively, many people anyway would say we're probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates. And it looked like the neutral rate might even be negative. So people were issuing debt at negative rates. It seems that's so far away now. My own sense is that we're not going back to that. But honestly, we're going to find out. But it feels to me and that the neutral rate is probably significantly higher than it was back then. How high is it? I just don't think we know. We only know it by its works.
One more. How do you respond to the criticism that will likely come that a deeper rate cut now before the election has some political motivations?
Yeah. So this is my fourth presidential election.
I hate that question.
At the Fed, and it's always the same. We're always going into this meeting in particular and asking what's the right thing to do for the people we serve, and we do that, and we make a decision as a group. And then we announce it, and that's always what it is. It's never about anything else. Nothing else is discussed. And I would also point out that the things that we do really affect economic conditions for the most part with a lag. So nonetheless, this is what we do. Our job is to support the economy on behalf of the American people. And if we get it right, this will benefit the American people significantly. So this really concentrates the mind, and it's something we all take very, very seriously. We don't put up any other filters. I think if you start doing that, I don't know where you stop. And so we just don't do that.
Jolene.
This
Thank
is
you,
going
Chair Powell. I'm
worse.
Jolene Kent with CBS News. My first question is, very simply, what message are you trying to send American consumers, the American people, with this unusually large rate cut?
This is like a
I
non-question.
would just say that the U.S. economy is in a good place, and our decision today is designed to keep it there. More specifically, the economy is growing at a solid pace. Inflation is coming down closer to our 2% objective over time, and the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy, and we'll do that by returning rates from their high level, which has really been the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level over time.
Some of these
Follow up to
comments
that.
might age very
Listening to you
badly.
talk about inflation moving meaningfully down to 2%. Is the Federal Reserve effectively declaring a decisive victory over inflation and rising prices?
Exactly.
No.
Patting themselves on the
We're
back
not.
big time.
So inflation, what we say is we want inflation. The goal is to have inflation move down to 2% on a sustainable basis. And, we're not really, we're close, but we're not really at 2%. And I think we're going to want to see it be, around 2% and close to 2% for some time. But we're certainly not we're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
It was literally just saying that everything's in great shape a second ago.
Hi, Katerina Saraiva with Bloomberg News. I just would love to know kind of how the committee is thinking about the persistence we've seen in housing inflation. Do you think you can return to 2% with housing inflation where it is?
So housing inflation is the
What is she
one
doing there?
piece that is kind of dragging a bit, if I can say. We know that
The word is
market
lagging.
rents are doing what we would want them to do, which is to be moving up at relatively low levels, but they're not rolling over. The leases that are rolling over are not coming down as much, and OER is coming in high. So, it's been slower than we expected. I think we now understand that it's going to take some time for those lower market rents to get into this, but the direction of travel is clear, And as long as market rents remain, relatively low inflation over time, that will show up. Just the time it's taking now, several years rather than just one or two cycles of annual lease renewals. So that's, I think we understand that now, but I don't think the outcome is in doubt. Again, as long as market rents remain under control, the outcome is not in doubt. So I would say it's the rest of the portfolio, or of the elements that go into core PCE inflation have behaved pretty well. They all have some volatility. We will get down to 2% inflation, I believe, and I believe that ultimately we'll get what we need to get out of the housing services piece too.
Some of your colleagues have expressed concern that with starting to cut rates, you could reignite demand in housing and see prices go up even more. What's the likelihood of that, and how would you react to that?
So the housing market, it's hard to game that out.
The rates are still way too high for that.
Frozen because of lock-in with low rates. People don't want to sell their home, so because they have a very low mortgage, it'd be quite expensive to refinance. As rates come down, people will start to move more, and that's probably beginning to happen already. But remember, when that happens,
they've begun moving in the last half an hour.
Seller, but you've also got a new buyer in many cases. So it's not, obvious how much additional demand that would make. I mean, the real issue with housing is that we have had and are on track to continue to have not enough housing. And so it's going to be challenging. It's hard to zone lots that are in places where people want to live. It's all of the aspects of housing are more and more difficult. And, where are we going to get the supply? And this is not something that the Fed can really fix. But I think as we normalize rates, you'll see the housing market normalize. And I mean, ultimately, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market and also by government.
Victoria.
Bad answer. The market doesn't like it at all.
Hi,
Market
Victoria
gone
Guida,
negative.
Politico. Just following up on some of the labor market talk earlier, monetary policy operates with long and variable lags. And I'm wondering how much you see being able to keep the unemployment rate from raising too much comes from the fact that you're starting to act now, and that's going to give people more room to run versus just the labor market is strong. And then also, if I could, following up on Nick's question, do you see today's 50 basis point move as partially a response to the fact that you didn't cut in July, and that sort of gets you to the same place?
So you're right about lags, but I would just point to the overall economy. You have an economy that is growing at a solid pace. If you look at forecasters or talk to companies, they'll say that they think 2025 should be a good year too. So there's no sense that the U.S. economy is basically fine. If you talk to market participants, business people who are actually out there doing business. So I think our move is timely. I do, and as I said, you can see our 50 basis point move as a commitment to make sure that we don't fall behind. So you're really asking about your second question. You're asking about July, and I guess if you ask, if we'd gotten the July report before the meeting, would we have cut? We might well have. We didn't make that decision, but we might well have. I think that's not, that doesn't really answer the question that we ask ourselves, which is let's look, when at this meeting, we're looking back to the July employment report, the August employment report, the two CPI reports, one of which came, of course, during blackout, and all of the other things that I mentioned. We're looking at all of those things and we're asking ourselves, what's the policy stance we need to move to? It's clear that we literally everyone on the committee agreed that it's time to move. It's just how fast do you go and what do you think about the path forward? So this decision we made today had broad support on the committee, and I've discussed the path ahead.
Elizabeth.
Thank you, Chair Powell. Elizabeth Schulze with ABC News. Mortgage rates have already been dropping in anticipation of this announcement. How much more should borrowers expect those rates to drop over the next year?
Why is she asking him?
Hard for me to say. That's from our standpoint. I can't really speak to mortgage rates. I will say that'll depend on how the economy evolves. Our intention, though, is we think that our policy was appropriately restrictive. We think that it's time to begin the process of recalibrating it to a level that's more neutral rather than restrictive. We expect that process to take some time, as you can see in the projections that we released today. And if things work out according to that forecast, other rates in the economy will come down as well. However, the rate at which those things happen will really depend on how the economy performs. We can't look a year ahead and know what the economy is going to be doing.
What's your message to households who are frustrated that home prices have still stayed so high as rates have been high? What do you say to those households?
Well, what I can say to the public is that
I have no idea.
We had we had a burst of inflation. Many other countries around the world had a similar burst of inflation. And when that happens, part of the answer is that we raise interest rates in order to cool the economy off, in order to reduce inflationary pressure.
We start increasing them when inflation is
not
at 7%.
Something that people experience as pleasant. But at the end, what you get is low inflation restored, price stability restored. And a good definition of price stability is that people in their daily decisions, they're not thinking about inflation anymore. That's where everyone wants to be.
Nobody's thinking about inflation anymore.
Inflation.
Nobody.
Keep
Are
it
you?
low,
I'm
keep it
not.
stable.
Nobody.
We're restoring that. So what we're going through now really it restores, it will benefit people over a long period of time. Price stability benefits everybody over a long period of time just by virtue of the fact that they don't have to deal with inflation. So that's what's been going on. And I think we've made real progress. We don't tell people how to think about the economy, of course. And of course, people are experiencing high prices as opposed to high inflation. And we understand that's painful.
Do you? Do you actually? I'm not sure.
Hi, Chair Powell. Greg Robb from MarketWatch.com. I was wondering if you could go through, you said just at the beginning that coming into the blackout, there was like an open thought of 25 or 50. The Fed could move either 25 or 50. I would sort of argue that when we had those two last speeches by Governor Waller and New York Fed President John Williams, that they were sort of saying that maybe a gradual approach was going to win the day. I mean, I sort of want to ask a 7-part question about this, but
oh no,
I mean,
no, don't.
Would you have cut rates by 50 basis points if the market had been pricing in like low odds of a 50-point move like they were last Wednesday? After the CPI number came out, it was a really small.
Why would you care about the Fed watch or whatever the futures?
Play in your
what a dumb
consideration
question.
at all? Just talk a little bit about that. Thank you.
We're always going to try to do what we think is the right thing for the economy at that time. That's what we'll do. And that's what we did today.
Simon.
I like how you shut him down.
Thanks, Chair Powell. Simon Rabinovich with The Economist. You've mentioned how closely you're watching the labor market, but you also noted that payroll numbers have been a little bit less reliable lately because of the big downward revisions. Does that put your focus overwhelmingly on the unemployment rate? And given the SEP projection of 4.4 basically being the peak in the cycle, would going above that be the kind of thing that would trigger another 50 basis point cut?
So we will continue to look at that broad array of labor market data, including the payroll numbers. We're not discarding those. I mean, we'll certainly look at those, but we will mentally tend to adjust them based on the QCEW adjustment, which you referred to. There isn't a bright line. It will be, the unemployment rate's very important, of course, but there isn't a single statistic or a single bright line over which that might move that would dictate one thing or another. We'll look at each meeting, we'll look at all the data on inflation, economic activity, and the labor market, and we'll make decisions about is our policy stance where it needs to be to foster over the medium term our mandate goals. Yeah, so I can't say we have a bright line in mind.
Matt Egan.
Thanks, Chair Powell. Matt Egan from CNN. I know that you discussed earlier how the Fed does whatever the right thing is and nothing else factors in. But In general, can you talk about whether or not you believe a sitting U.S. president should have a say in Fed decisions on interest rates? Because that's something that former President Trump, who obviously appointed you, has previously suggested. And I know the Fed is designed to be independent, but why? Can you tell the public why you view that so important?
What a non-question.
Sure. So countries that are democracies around the world, countries that are sort of like the United States, all have what are called independent central banks. And the reason is that people have found over time that insulating the central bank from direct control by political authorities avoids making monetary policy in a way that favors maybe people who are in office as opposed to people who are not in office. So that's the idea, is that, and I think the data are clear that countries that have independent central banks, they get lower inflation. And so we do our work to serve all Americans. We're not serving any politician, any political figure, any cause, any issue, nothing. It's just maximum employment and price stability on behalf of all Americans. And that's how the other central banks are set up too. It's a good institutional arrangement, which has been good for the public. And I hope and strongly believe that it will, continue.
Kyle.
Kyle Campbell for American Banker. Thanks for taking the questions, Chair Powell. A couple regulatory developments in the past week that I want to ask you about. First, last week, Vice Chair for Supervision, Michael Barr, outlined his views for the changes to the Basel III Endgame. I'm wondering if you are in alignment with him on what those changes should be, if those have support on the board in a broad way that you're looking for, and if you think the other agencies are also fully on board with that approach. And then yesterday, other banking regulators.
You know what? Hold the second question.
Okay, sure.
Yeah.
But
also,
the second question.
I don't know really what this is about.
The answer to your question is that, yes, those changes were negotiated between the agencies with my support and with my involvement, with the idea that we were going to repropose the changes that Vice Chair Barr talked about, and then take comment on them. So yes, that is, that's happening with my support.
Okay. Is there a date for that?
That's not a final proposal, though. You understand? We're putting them out for comment. We're going to take comment and make appropriate changes. We don't have a calendar date for that. And as for the other agencies, the idea is that we're all moving together. We're not moving separately. So that I don't know exactly where that is, but the idea is that we will move as a group to put this again out for comment, and then it'll come. The comments will come back 60 days later, and we'll dive into them, and we'll try to bring this to a conclusion sometime in the first half of next year.
Right. And then yesterday there were
this guy from the 80s?
Merger reform finalizations from the other bank regulators. Well, what does the Fed have to do to align itself on merger?
I would bounce that question to Vice Chair Barr. It's a good question, but I don't have that today. Thanks.
Okay, Jennifer for the last question.
Last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said earlier that the decision today reflects with appropriate recalibration strength in the labor market that can be maintained in the context of moderate growth. Even though the policy statement says you view the risks to inflation and job growth as roughly balanced. Given what you've said, though, today, I'm curious, are you more worried about the job market and growth than inflation? Are they not roughly balanced?
No, I think, and we think they are now roughly balanced. So if you go back for a long time, the risks were on inflation. We had a historically tight labor market, historically tight. There was a severe labor shortage. So very hot labor market, and we had inflation way above target. So, that said to us, concentrate on inflation, and we did for a while, and we kept at that. The stance that we put in place 14 months ago was a stance that was focused on bringing down inflation. Part of bringing down inflation, though, is cooling off the economy and a little bit cooling off the labor market. You now have a cooler labor market in part because of our activities. So what that tells you is it's time to change our stance. So we did that. The sense of the change in the stance is that we're recalibrating our policy over time to a stance that will be more neutral. And today was, I think we made a good, strong start on that. I think it was the right decision. And I think it should send a signal that that we're committed to coming up with a good outcome here.
What did that even mean?
Vulnerable to a shock now that could tip it into recession.
I don't think so.
I don't think so. Print that.
As I look, well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of a recession, of a downturn is elevated.
I love it.
I don't see that.
I need
You
to clip
you
this.
see growth at a
Need to-
solid
need to
rate.
clip this.
You see inflation coming down, and you see a labor market that's still at very solid levels. So I don't really see that. No. Thank you.
Thank you.
Oh, what an end. What an end. All right. Let's quit this. So, yeah, that was the press conference. There was a lot of blah, 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 very little in the way of answers. I think some of the commentary was somewhat disingenuous when he was saying that that the new jobs data and job openings data is in a good place and the economy is very healthy, when there has been a very sharp reduction in job openings and a big reduction downwards in new jobs being taken and unemployment creeping up. I think it was not a good press conference. And interestingly enough, if you while this was happening, the S&P 500 just went right back down to being flat for the day. Like literally it's 0.07% as I'm talking. But towards the end, he was asked, does he think there is a risk of recession? And he said categorically no, and made a few statements that sounded extremely funny given where the data is currently pointing. I guess we'll have to wait and see as more data arrives. Thank you very much, everyone, joining me. I really appreciate it. I've really liked so many people joining and all the chat. Thank you so much. I should do a few more of these lives. For anyone in the Discord, let's keep discussing it in there. If you want to join the discussion, link to patrons in the description. And I'll see you guys later.